Well, markets are mixed today as investors await that latest round of earnings. For more on the market moves and what's ahead for stocks, let's welcome in Ryan Detrick, Carson Group Chief Market Strategist. Ryan, is it fair to call you a perennial optimist? Because when I was looking at your note today and you were talking about, the momentum that we were seeing behind stocks, it reminded me that you usually are pretty cheery.
Well, I guess that's probably true. Thanks for having me back. I've been coming on with you guys for a while saying, listen, we're probably going higher, and we're still in that camp. And you've had some great discussions before I joined, but really, I think I want to focus on this for a second here. This month, October, we haven't had a 1% up or down day on a closing basis on the S&P all month. I know there's one more day to go. Only twice in 50 years have we seen that in October. 29 days in a row now. We haven't had a 1% move. What's that mean? That's the longest streak in 3 years. I don't think anyone, including myself, on their bingo card a month ago said this would be like the least volatile October we've ever seen ahead of an election. But here we are. Isn't that interesting?
And Ryan, so the question investors have is how long the good times continue. You say, you know what? Maybe it could last longer than a lot of folks expect.
No, that's right, Josh. We just reached the third year of this bull market, right? The second birthday, which is a couple weeks ago. I took a look, again, going back 50 years. I found 5 times the bull market made it into its third year. So it's kind of like I said like this. Once you're 65 years old, the odds of getting to 85 are really, really high. Bull markets aren't all that different. Looking at those previous 5 times that made it into the third year, like this one. The average was 8 years. The average gain was 288%. This current one is about 2 years old and up about 62, 63%. So who knows? But I'm just saying in history, if you look at history, these bull markets can last a while. And last comment on this, we get into the economy if you want. The economy continues to surprise the upside and earnings are still strong. We simply do not see a recession on the horizon.
So I guess my question would be, what could derail all of this? I mean, we were just, of course, talking about the earnings that we're awaiting from Microsoft and Meta. We got a lot more earnings to go. We got a jobs report. We have more inflation data. We have the Fed. Oh, and we have the election coming. I mean, how are you sort of weighting all of those, and which might be the riskiest for the market?
Yeah, I think the Fed, right? I think the F word. The Fed could be the riskiest. We've been in the camp that inflation is last year's problem. We've been saying that all year. And we think the Fed can continue to cut. Keep this real simple. Productivity in our country is very, very high right now, Julie, for 5 quarters in a row. When you have higher productivity, you can have higher wages. The Fed can cut and usually puts a cap on inflation. That's a theme we've been talking about at Carson Group for a long time now, and it's playing out. But just for everyone to put some context around what's going on right now, the S&P is up 5 months in a row. We're like 1 day away from probably being up 6 months in a row. We'll be up 11 out of 12 months in a row. It's been an incredible run, obviously. So I guess the logical thing is, could you be due for a break? Yes, right? We're not naive to the fact that that's pretty amazing. So maybe we're just due for some break or consolidation. Perfectly normal. But the reality, I think the Fed, a policy mistake, is kind of that one thing, along with the black swan. We've got obviously wars all over, different things that could happen. We're not ignoring those, but I think the Fed is the one that gets us. We think they should continue to keep cutting here.